Now, a typical argument from someone living in a high income tax state is, we don't have any sales taxes, or we have very low sales taxes. Unless you live in California or New York, where you kind of have both. But one massively overlooked advantage of no income tax states is the capital gains tax savings. So states that don't have income taxes also don't have capital gains taxes at the state level. Now that might be wildly important for an employee who's equity based and has a bunch of employer stock, or just anybody with a taxable portfolio. So for example, if you lived in Portland, Oregon, and you looked across the water to the Columbia River, the mighty Columbia River, and you said, there's Vancouver, and across there in Vancouver, if I can just swim there and I can domicile there in the state of Washington, and I sell my stock after domiciling correctly in the state of Washington, I would save 10% on my taxable gain. It's big savings if you have a large taxable gain. But perhaps, the bigger challenge here and question is just, when should I realize a capital gain? I've seen investors chase tax plays, ditching the fundamentals of good investing for pursuit of a few $100s of tax savings. And I especially see equity-based individuals struggle with this, but people, with just traditional tax portfolios that have, a low basis and, let's say a large gain, they can really gain a sense of paralysis where they just are unsure how to best unwind those positions. And, the sayings that will float around when this is occurring, right, are in various forms, but they all kind of carry the same underlying meaning. We're at 65. I'm going to wait until we get back to 65 because we were at 65 a month ago. Well, our earnings report came out recently. We looked pretty good there. I work for the company and I feel pretty good about where we're headed, right? We all seem to view ourselves as the exception to emotional investing. But we all struggle with this paralysis, these little voices that float around in our heads. And a capital gain, that's something that you have to deal with likely at some point, unless you just wait until you die. So while you may save taxes by waiting to realize the gain until you actually move to this new state, the belief that the stock will just grow in the waiting period is a false pretense. So this question of, what do I do with this large capital gain? That's highly subjective to one's personal situation. So when we get faced with that question, we take similar measures as a lot of the different pieces I mentioned before. So run out the scenarios and obviously consider the solution in accordance to each person's unique plan. And that means balancing risk management with tax plays. But rather than just give you generic advice, I'll leave you one piece with this. From my experience working with this with a lot of individuals, we tend to look at each decision as this or that, when maybe the far more appropriate answer is what combination of strategies and risk management makes the most sense. How does it all come together in the most efficient way?